Hi, today's February 1. I'm Keith Weiner, President of Gold Standard Institute USA and CEO of Monetary Metals. Last week in our video, we made a contrarian prediction that the silver price was likely to correct, especially against gold. We looked at the gold-silver ratio, which is the gold price divided by the silver price, and called for the gold-silver ratio to rise to at least 60 and perhaps closer to 70. This was contrarian as against all the rumors that you may have been reading and seeing on the internet about silver shortages. So specifically, we looked at the gold basis and the silver basis. We saw the gold basis rising and the silver basis falling. And we said that a rising basis indicates rising abundance, and a falling basis indicates rising scarcity. So gold has rising scarcity and silver has rising abundance, at least as compared to gold. So based on that, we concluded that silver was likely to correct against gold. In a previous video, we looked at the correlation between open interest and price. Open interest is the number of futures contracts that are open at any given time. And so it's logical that as people buy up the futures contracts, more of them are issued and the price is rising due to all this buying. And of course, the opposite is true when they're selling those contracts. The open interest is falling and the price is falling. So today, let's take a look at another data point which may corroborate our prediction of last week. Let's take a look at the open interest in gold and silver. Two things should be obvious in looking at this chart. The gold open interest is falling. It's now at a multi-year low. The silver open interest, on the other hand, is rising. It's now at a level last seen April 28, 2011. Many of you may remember what happened on that date. Silver hit a price of $49 briefly before crashing to $33 a few short trading days later. The question, therefore, is what's different today? Well, in 2011, the price was rising because it was supported by both strong physical buying and strong speculative buying. Both buyers were driving the price higher until the trends had exhausted themselves and then the price collapsed. Today, on the other hand, the price isn't really rising like that. It's moving sideways because it's not being supported by physical buying. That's what our rising basis today is telling us. Physical buying is relatively weak compared to futures buying. Today, the silver price is supported by futures buyers. So obviously, when the futures buyers become exhausted, the silver price could very well correct in a severe way. So I want to emphasize something here. The analysis that we're talking about is not technical analysis, and it's not timing analysis. There's nothing that says that the silver price has to crash Monday morning at 9:32 a.m. in New York. Although it might not. But because the silver open interest is so high, last seen at a time when the silver price had crashed violently, we think the time for the silver correction may perhaps be drawing near.